Welcome to our channel, where we demystify the world of finance and empower you to take control of your wealth. Today, we're venturing into the exhilarating realm of stocks. Stocks, in essence, are your ticket to owning a piece of a company. They represent a claim on a company's assets and earnings. But how does this all come together in the grand scheme of the stock market? How does one navigate this intricate web? But how does it all work? We're about to break it down. At its core, a stock is a financial instrument that gives you a stake in a company's assets and earnings. Picture it like a slice of a giant corporate pie. When you buy a stock, you're buying a piece of that pie, which is your share in the company's assets and earnings. But why do companies slice up their pie and sell it to people like you and me? The answer is simple: to raise capital. Companies need funds to grow, innovate, and expand their operations. Instead of taking on debt, they sell shares of their company to investors. In return, investors get a chance to participate in the company's success. Now, you may be wondering where these stocks are bought and sold. This happens on platforms known as stock exchanges. The New York Stock Exchange and the Nasdaq are two of the most well-known stock exchanges in the world. On these platforms, buyers and sellers come together to exchange shares. The price at which a share is traded is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. Stocks are traded on stock exchanges such as the New York Stock Exchange or the Nasdaq, where buyers and sellers come together to exchange shares. This is the fundamental concept of how the stock market operates. Now that you understand what stocks are, you might be wondering why you should invest in them. You see, stocks hold a unique position in the world of investments. They offer the potential for substantial returns over the long term compared to other forms of investments like bonds or savings accounts. Just picture this: if you invested $1,000 in a savings account with a 2% annual interest rate, after 10 years, you would have around $1,200. However, if you invested the same amount in stocks with an average annual return of 8%, you would have over $2,100 after 10 years. That's almost double the amount you would earn from a savings account. But the potential for high returns is just one side of the coin. Stocks also offer the opportunity to earn dividends. Dividends are essentially a portion of a company's profits that are distributed to its shareholders. This means that as a stockholder, you not only benefit from the appreciation in the stock's price over time, but also receive a share of the company's profits. Investing in stocks also allows you to participate in the growth stories of successful companies. Imagine being a part of a company's journey as it grows from a small startup to a global powerhouse. As a shareholder, you get to share in the company's success. Moreover, stocks offer a hedge against inflation. With the average inflation rate being around 2%, investments that offer lower returns might not be able to keep up with the rising cost of living. However, stocks, with their potential for high returns, can help you maintain the purchasing power of your money. Finally, investing in stocks is a way to build wealth over time. With patience, discipline, and a well-diversified portfolio, stocks can be a powerful tool for wealth creation. Additionally, investing in stocks allows you to participate in the growth of successful companies and benefit from dividends. Ready to dip your toes into the world of stock market investing? Here's how you can get started. The first step is education. Like any journey, the road to successful investing begins with understanding the landscape. This means familiarizing yourself with financial terminology, understanding how the stock market works, and learning about different investment strategies. There are plenty of resources available, from books to online courses, that can help you gain the knowledge you need. Next, it's important to determine your investment goals. Are you investing for retirement, to buy a house, or perhaps to fund your child's education? Your goals will influence your investment strategy and the types of stocks you invest in. Closely tied to your investment goals is your risk tolerance. This is a measure of how much financial risk you're comfortable taking on. If the thought of your investments fluctuating in value makes you nervous, you might have a low risk tolerance and prefer investing in stable blue-chip companies. On the other hand, if you're comfortable with taking on more risk for the potential of higher returns, you might be drawn to smaller, growth-oriented companies. Once you've laid this groundwork, it's time to open a brokerage account. A brokerage account is like a bank account, but instead of holding cash, it holds your investments. There are many online brokers to choose from, each with their own set of fees, tools, and investment options. Look for a broker that aligns with your investment goals and preferences and offers a user-friendly platform for trading stocks. The final step is to start investing. You can do this by buying shares of companies you believe in and expect to perform well. Remember, the goal is to buy low and sell high. Then open a brokerage account with a reputable online broker that offers user-friendly trading platforms and access to a wide range of investment options. Before you dive in, here are a few tips to help you navigate the stock market with confidence. First off, start small. There's no need to pour your life savings into stocks from the get-go. Instead, begin with a modest amount that you can afford to lose. This will give you a chance to learn the ropes without taking on too much risk. Next, diversify. This is one of the most important principles of investing. By spreading your investments across different sectors, industries, and geographical regions, you can reduce the risk of a single stock or sector dragging down your entire portfolio. Think of it as not putting all your eggs in one basket. Now, on to research. Never invest in a company without understanding what it does and how it makes money. Look into its financial health, competitive position, and growth prospects. Reading financial news and following market trends can also provide valuable insights. And finally, resist the urge to time the market. It's nearly impossible to predict short-term market movements accurately, consistently. Instead, focus on building a solid, diversified portfolio and stick to your investment plan. Remember, investing is a long-term journey, so stay patient and disciplined. Don't let short-term market fluctuations distract you from your long-term goals. And remember, every investor makes mistakes. What's important is that you learn from them and keep moving forward. Now let's pause to consider some common pitfalls that you as a new investor should avoid. 1. Emotional investing. Investing based on emotions or hunches can lead to poor decisions. Always base your decisions on thorough research and rational analysis. 2. Chasing hot stocks. Jumping on the bandwagon of the latest popular stock can be risky. Remember, what goes up must come down. 3. Over-monitoring your portfolio. Checking your portfolio every day can lead to stress and impulsive decisions. Remember, investing is a marathon, not a sprint. 4. Lack of patience. Rome wasn't built in a day, and neither is wealth. Be patient and give your investments time to grow. 5. Ignoring the bigger picture. Don't get so focused on individual stocks that you overlook the health of your overall portfolio. Remember, by avoiding these common mistakes, you're already ahead of the game. Now let's wrap things up. Congratulations. You've taken the first step towards building wealth through stock market investing. We've journeyed through the basics of stocks, the potential benefits, and even some strategies for getting started. Remember, successful investing requires knowledge, patience, and a long-term perspective. Don't stop learning. Continue to equip yourself with financial knowledge. If you found this video helpful, be sure to like, share, and subscribe for more financial insights. Until next time, happy investing.